Hello, everybody. Thank you for joining. We have already some people watching. That's great. I welcome everybody. Today, we are going to discuss an investment through an SPV being a special purpose vehicle. We're going to discuss what it is, how to decipher it, and how to understand it. And I am joined by two lovely gentlemen. Aleksander, he is currently working at Dealum together with me, and he is running and heading the accelerator department. We are expanding into that direction, and he is the man behind the whole process. And I'm also joined by Sebastien from Uniborn, and Uniborn is the platform that facilitates the creation of SPV. And I will let gentlemen present themselves. After I say that I'm Daria, I will be hosting today's event, and I have joined Dealum to head the marketplace and work on different business projects. So I will start with Sebastien, as you're our guest today. You can introduce yourself and tell us a little bit more, what does Uniborn do and what is your background?
Yeah, absolutely. Thank you so much for having me, Daria and Aleksander. It's great to be here. So my name is Sebastien. I'm the Chief Community Officer here at Uniborn, and basically spent the last 10 years working in the tech industry, helping founders to connect with investors, mentors, and corporates. So first through events, later on through acceleration and incubation program, and then now through this platform that we're building together with Dmitry, the founder of Uniborn. So what we do is relatively simple, right? So we're building a community of investors, mostly angel investors, but other types of investors too, and founders, in order to facilitate access to early stage investment. And the way that it looks like currently is that Uniborn is facilitating SPVs and getting early stage investment through that way. But there's a lot of other things that we want to build into the future through that community and around that community. I think a lot of people can currently compare us to a European version of AngelList. For those of you who are familiar with what they've built into the US, we see a huge opportunity for the growth of the early stage investment landscape, particularly in the European market currently, and really want to try to harness that and make it much easier for investors to come together and then to invest in early stage founders, and for those founders to be able to funnel the money without the general bureaucracy that comes around it. So in a nutshell, that's what we do.
Great, thank you so much. And Aleksander, please present yourself.
Yes, thank you, Daria. As already said, doing product development and business development for accelerators in Dealum, but I've been doing accelerators for 10 plus years already. So I founded the Build It Hardware Accelerator, and we also have a pre-seed and seed fund, which invests into the teams who are within our own accelerator. So we have done close to somewhere between 80 and 90 deals. So not 100 yet, but then adding my angel investment on top of it, it's over 100 till date. So seen quite a few ways how to structure the deal, but also what everything can go wrong. So very excited to be here. Thank you.
Great, thank you both for joining. So Aleksander will be providing today his investor perspective, and Sebastien will be sharing on the whole process, how it all works, and also how the guys are automating this process to make it more streamlined, and as everything now is more digitized and technology based, to make it smooth. I will share a few words, and I will share a small slide presentation about Dealum in itself. If you have joined and you don't know who we are, Dealum is the leading deal flow management platform for investors, and we are trying to build a more connected ecosystem, early stage investment ecosystem into startups. And now we are also promoting ourselves a little bit more for startups, as we have built a very good investor base already. And we try to make the whole process for startups more streamlined. You have one platform where you have an ability to manage all your applications to different business angel groups, standalone investors, and also accelerators. And you have basically a central hub to communicate with them, not to go into a bazillion different emails. Everything is in one place. You can also share your progress with investors. So it's all in one place. And also Dealum in numbers a little bit. In the past 12 months, we had about 123 million committed on Dealum, but different investors. And we have about 80,000 companies already registered. And we have about 23,000 different investors on the platform. That's it. This is Dealum in the nutshell. Not to bore you with all the other details about the both companies, we will get right into the juicy stuff and figure out what is SPV and how to set it up, and do you need to set it up. We start with the warm-up question to Aleksander. What are generally angel investment opportunities, and how angel investors can invest in which ways, and how is all that thing done?
Yes, well, thank you, Tara. I think it's a very good warm-up question, because I see two sides of it. In a way, it seems so simple, but people almost don't pay attention to it, and then they end up being in a lot of trouble later. And on the other way, let's say if it's your first round which you're raising and you haven't done it before, then it seems like overly complex and so many options to choose from. So I would look at it and trying to simplify it to the point where there's basically two ways how investors can put money into the company. Largely, it's two ways. One is straight into the equity, so they become shareholders from day one. And another one is a loan or debt, which means that, which is typically a convertible loan instrument. That means that I'm giving you money, and in your balance sheet, this is as a loan. However, I have the right to convert that loan later to shares when I will become a shareholder. So that's largely two main ways. There's, let's say, there's modifications of one and the other. There's convertible loan and safe notes and preferred stock and common stock and etc. But I would not go into that detail today. And then if we talk about SPVs and how they fit into the picture, then we're already talking, let's say, more about the structure which is behind the instrument. So what I would describe is an instrument, but I think it's important to understand that behind an instrument also there needs to be a structure. And what I've seen as structures which have been used are mainly, a lot of angels are investing as private individuals. This is completely okay. However, much more common is that they are investing through their own holding companies, which means that they have a company which they're 100% owner, which invests their own capital, and that company then will become the shareholder in your company. And then we have people pooling money together, typically in the form of an SPV. And that's usually kind of the main, let's say, three ways of investing if you're an angel. So in venture capital, it becomes sometimes a bit more complicated. But again, I would not go into that probably right now. Later, if there's a question, happy to do that. So back to you, Daria.
Thank you so much for your insight. And now that we understand a little bit how different versions of investments for angel works, we can go into the juicy stuff of understanding what is SPV, how does it function in the context of early stage investment or angel investment. And I will give opportunity to Sebastien to explain it to us.
Yeah, absolutely. More than happy to. So you've kind of mentioned it a little bit earlier, but an SPV, or special purpose vehicle, right, is a legal entity, generally a limited liability company, created to fulfill this kind of very narrow goal or narrow, let's say, specific purpose, right? So it's often to isolate a firm from financial risk. That's kind of the general reason why people do that. But in the context of startups, it allows founders to raise funds from multiple investors, mostly angel investors, as Aleksander mentioned, and then bundling their money together in order to transfer that in one go. So that's generally how it goes and what an SPV is. Why do we do that? Or why do, as a company, we decided to start helping to create those SPVs is because once you want to invest individually as an angel, it's not that difficult in most jurisdictions, at least in Europe. But once you want to start bundling that together or investing as angel investors with multiple investors, then it starts to be quite messy. And often it is because it takes a lot of resources, mostly time, and then organizing all of the information and all the contracts that come with it is basically then end up being quite costly. And we all know that investors are busy people who don't have a lot of time. And this is kind of where, let's say, the difficulties happen, right? So registering an SPV allows to do a few different things. First of all, it allows for a single contract to be signed by a lead investor, rather than having to have all the different independent investors sign separately the same documents with the founders. If you have only 1 or 2 or 3 angel investors, it's not a huge problem. But if you start having 20, 15 or 20 or 25 different investors, you can imagine the time that it takes to go back and forth to sign 20 different contracts with 20 different investors. The second one is that it also allows to have only a single name on the cap table. We all know that when you get to later stage of investment and you start to involve VCs, they generally want a very clean and simple cap table. And having only one name being the registered SPV rather than having loads of different names of angels is much better and much easier, unless there are specific angel investors that are very famous so that have a name that everybody would like to see on their cap table. But if that's not the case, then it's generally more complicated. It also allows for having smaller investment checks being invested into that company. So let's say that you want to invest as little as $1,000 or $2,000 or $3,000. You can do it via an SPV, whereas it's generally much harder to get on the cap table if you don't have a check of $5,000, $10,000 or $20,000 in general, if you're an individual angel. So that's something to keep in mind as well as a founder, is that by doing it through an SPV, you are allowing smaller checks to come and be able to receive money from people who don't have as big of a source of fund. And then I would say the last one is the whole governance becomes a lot easier and cheaper, right? So even in terms of liquidity event, that can be discussed with the lead of the SPV, the lead investor of the SPV, and potentially you can have some of your investors swapped within that SPV without having to bother the founders or make edits to the cap table, which again is time-consuming and costly. So there's a number of reasons why SPVs exist in general within the structure that Aleksander referred to.
Thank you so much. I will also mention for the audience, if at any point during the conversation you have a question, you can drop it in the chat from wherever you're watching or on the StreamYard itself. And when at the end, if we have time, we will be answering some of the questions, but also hopefully during the process, we will answer the majority of them. But if you have a very specific one, you can drop it into the comments. And now we can move on to the next question, now that we understand a little bit better what is an SPV and why we actually need it for founders to just basically pool all of the investment into one vehicle or just a company as LLC, as Sebastien mentioned, and then for the ease of the process. So you have to communicate and sign only one contract instead of trying to juggle 75 different angel investors, and also to have a cleaner cap table. So those are the easy way of putting it. But we would like to also understand a little bit better what are advantages, and now we know the advantages more or less, but what are the disadvantages of that process? And also, are there any specific pitfalls founders have to be cautious about? Anything like that. So anything that can actually hurt you in the long run. Maybe Aleksander, you from your long experience of angel investing and actually facilitating some of these processes can share your insight on this.
Yes, so thank you. So Sebastien, as you said, pretty much covered kind of what are the advantages in terms of if you happen to be a startup. What I also, at least for me, it's interesting also to understand like what happens on the other side of the table. So also happy to tell you why kind of investors love it, right? So for investors, there's also a lot of advantage, and I think it's better to understand also what the other party is thinking. And I'm like, what's the word? Like kind of known for speaking very frankly and not caring about being politically correct, right? So and one of the advantages actually for angels is that it's a myth that all investors actually wants to be hands-on in your company. They don't. Most of the investments which I've done as an angel, I'm fairly passive. Not to say I'm like absolutely passive, and I don't actually want to get my hands, let's say, dirty doing business for them. So and it's much more to hide myself behind an SPV, right? So if I don't have to go to the shareholders meeting, I don't have to sign any documents. And if there's a trust between me and the lead investor, that's the easiest way to invest, really. So a huge advantage also for investor. And also, if I would summarize what Sebastien was saying out of my own experience, that the first fundraising which I did for my own company was, where I think the first closing was 360,000 or something like that. That was over 10 years ago. That was more money than it is today, but still not, let's say, a lot of money. But we ended up having, I think, something like 18 investors from 5 different countries, right? So, and how I would summarize this experience is that the smaller the shareholding, the bigger the likelihood that that person thinks they run your company. So there's a very strong correlation between amount of money and thinking that you own the company, but it's correlated in a negative way. And typically, the bigger the investor, the less interested they are in the sense kind of how you are doing on an operational level, right? So an SPV is a good way to solve actually that issue. Disadvantages. Sebastien actually already went into it. He presented it as a good thing, which is that the owner can change. And in a sense, it is good. So let's say if you have a typical structure where all the investors are on your cap table, and when somebody wants to leave or somebody wants to share their shareholding to another investor, it's a lot of trouble, because that typically means that all shareholders need to agree, and then you need to notify the business registry, and then it might happen that the shareholders are from different countries. Then you need power of attorneys. It's a mess, right? What is then the disadvantage, however, if it's easier to swap the owner? Well, let's talk about confidential information. So SPV typically have direct access to all the confidential information, sometimes even your bookkeeping, your contracts which you have with your partners, your contracts which you have with your employees. And now you think that I invested in your company, and you have actually no idea that 3 years ago I already sold my shareholding, and now it's your competitor instead of me, and having direct access to what you have. So this might happen much more easily with an SPV, because you as a startup don't actually know, and you have no control whatsoever what happens within the SPV, right? So this is one thing, but what might happen. Then typically control is another issue, but I would say that's more of advantage in terms of startup. You have one person you need to typically talk to. However, for me as an investor, this can become a disadvantage, because I don't really have like almost any control anymore. I give it up to my lead investor, and then if something goes wrong, I might be actually in a not a very good position to negotiate or to even to do anything about it, right? So this is one disadvantage for me as an investor. So not all investors actually like SPVs, and the reason is that they would like to have direct control to your company, and not some like indirect and not having it at all. And then the time input, I would also say, might be disadvantage, because if you put SPV in between you and an investor, with every step which you have in between, let's say 2 individuals, the commitment gets less, right? So if I'm direct shareholder within your cap table, I have a sense of ownership, right? So I feel that, I'm the owner, I'm happy to help out, happy to do introductions. If there's an SPV, that means there's a one filter in between. This filter typically is lead investor. So all the information gets filtered by lead investor, and he gets to decide what he will send to the SPV investors, what he will not send. That means also that the commitment on both sides is actually weaker. And so if you go out and want to reach out for an introduction for one of the SPV investors, it's going to be much more difficult because sense of ownership is smaller. So kind of that would be kind of first things top of the head, which I would mention, which I would really see that they actually have influence. And then there's a lot of legalities, but they're mostly really don't influence your day-to-day operations.
Thank you. That's actually, you touched upon what I was thinking, because so when Sebastien said that it's easy to swap the owner, I was also thinking, what if this the other person who buys the shares is someone who you don't really want to have on your cap table? And we all know, especially if it's your first investment or the second investment round, that means you have to have this person for the next, I don't know, 10 years almost. And then even though if it's a smaller investment, then they have less opportunity to disturb your day-to-day life, but still having someone you don't really want to be there and not knowing about it, as we know now, is something of a issue. Now we know. Good. Thank you so much for that particular answer. Maybe you want to add something, Sebastien? Or
yeah, I was going to say maybe a little caveat on this part. I think it's not so much that it's so easy to do without people knowing, or kind of do it, behind the back of the founders. Like, there still needs to be discussions between the investors involved, depending on the clauses that you've decided in the agreement with the lead investor. There might need, to be a vote involved or approval of the lead investor as well, which most likely would discuss it with the founders. I think it's, if everybody is on board to swap some of those investors or offer liquidity to some of those people, you can do it without having to go through kind of the legal trouble that Aleksander has discussed and the cost involved in order to swap those people. So it's not that, I guess, it happens that easily, but to some extent, if everybody was on board to do it, you can do it without having sort of the costs that are generally involved with such transaction.
And now that we are already on that topic, maybe we can touch upon what is the setup process and the management process. So that was the management process, basically, after the whole legal is done and you are already living your life and spending that investment money. There is also some of the caveats that you need to, you as a founder, maybe not, but as the SPV owner and the manager, you need to do some things and jump through some hoops for the duration of SPV life. So my question would be probably to Sebastien, as you are taking care of that. First of all, what is the setup process? How to create this magical vehicle of SPV, and how to manage it after the investment has been done, how long you have to do it, and then also maybe you can touch upon who takes care of which part. So me as a founder, do I have to actually take active role in setting it up and managing, or I just get money and go buy a yacht, put #investor money, and I relax and do whatever I want? So for me as a founder, how this process looks like?
No, it's a good question. So from that perspective, I would say that as a platform, we are mostly dealing with investors. So we obviously care for founders, and it is designed to funnel money to founders, but we are mostly sort of at the interface with investors. And in that case, with the lead investor, which is sort of one of the most important. And I think going back to what Aleksander was mentioning, I think a lot of the potential issues that arrive with those SPVs come from either a lack of trust or a lack of transparency with regards to information sharing from that lead investor. So I think as an independent angel that is looking to potentially invest via an SPV, you want to make sure that you trust the individual that's going to be leading that deal, and that the, let's say, documentation in that deal process in terms of how the information is going to be communicated by the lead investor, how often, what type of information is communicated, that all of that is clear, because he's kind of he or she is the cornerstone investor that is going to be kind of in charge of setting these things up together with us as a platform. So the process is relatively simple. So for us, I would say first, as a platform, we're going to be onboarding the lead investor, which is quite simple. They're going to sign up. Uniborn is mostly mobile first. We will also have a dashboard that you can use on your desktop, but we kind of realized that a lot of angel investors are communicating between each other through either Telegram or WhatsApp groups, so a lot of it happens through the phone anyways. So we're kind of mobile first in that sense. We're going to be deciding on the terms of the deal and the investment memo. A lot of that we kind of have as a template to start with, but then they can the deal lead can actually take that template and then adjust it depending on the terms that they want. And then once we agree on what that deal looks like, we can publish it on the platform under the syndicate that they create on the Uniborn platform. And then after that, they can share it with the potentially interested investors. So some of those already, have, let's say, groups of investors that they're working with. For on Dilum, for example, some of them are not yet using Dilum and might be doing it simply via WhatsApp groups or via email chats. It depends a bit on the investors we talk to, and then these investors will be deciding on their allocation. So they say, okay, I'm interested in investing in that deal. How much do I want to put in? We have a pretty simple progress bar that shows how far we are in the allocation decision, and then when we get to 100% of the amount of money that's committed, then as a platform we go through 6 different things. So first of all, we create the SPV. We register it as a limited liability company in Estonia. After that, we opened the bank account for the said SPV. I think it was very easy with Wise for a long time. Then there's been some issues end of last year. We have actually another potential providers with whom we can do that within 20 minutes at this stage. So it's pretty quick. But there's a number of different ways in which you open the bank account. Then after that, we take care of KYC. At Uniborn, this is something that we outsource to some other providers that have been doing that for a long time. And then we take care of AML, which we do in-house. So we've got anti-money laundering officer in-house that reviews all the investors and make sure that the money is coming from where it should come from and from the people, and in which jurisdiction they're based. And then after that, we collect the money from the investors into the SPV bank account. And then we wire that money from the SPV bank account to the founder's account. So that's basically how the process functions. First, we agree on the terms of the deal and what the deal looks like with the lead investor. Once everybody agrees, we share it with the people and then get the commitment of the other investors involved, and again go through the 6-step process in order to funnel the money from the investors all the way through to the founders.
And so that was the setup process. Is there anything that founders have to take into the account after the deal has been done, the money has been wired? Now you have a company basically on your cap table. Do they have any involvement in management of the SPV? And if yes, what they have to do? And if not, then also share a little bit what investors have to do to manage SPVs. Because as Aleksander very well said, you need to know what's going on in the minds of other people when you, in this case, when you set up SPV, in the minds of investors, what they have to take care of.
Yeah, absolutely. So in terms of the founders, there isn't a lot that's required from their side. In terms of the investors, it depends a bit on the setup that they've chosen. So I think Aleksander mentioned being on the cap table or, shareholders in the company. It is an opportunity. We can do that as a platform to make sure that the investors, or the SPV in this case is shareholder, right? That all the investors are. What we do most of the time with our clients is that we set up this special purpose loan that the SPV is making to the founders. And in that case, it means that they're not on the cap table directly, but through the loan at exit, they basically get a pro rata to the growth of the company. And that's basically the easiest way to set it up from a tax perspective, because it means that tax is only triggered at exit. So that's what most of our clients are opting for. But if there was a requirement to be on the cap table straight away and become shareholders, they can do that as well. Then at that point, they have to take a look at what the tax implications of this is. So we can't give tax advice, as you would know, most of the service providers don't, but we have sort of a general understanding of what needs to be done at what moment. And I think most of our clients decide to do that later on. From the management of that SPV, we basically charge a basic 2% fee of the amount raised to manage that entire process. It's a one-time fee that we take at the beginning at registration. We're not actually charging neither the founders or the angel lead afterwards for the management. And it's a simple sort of tax filing that happens every year that we take care of on the Uniborn side. We kind of reserve that money initially for the 10 years that it can take to manage that in the future, and then take care of filing this every year. Also, something that might be interesting to mention that a lot of our clients are asking, or the angel leads are asking, is kind of what happens if we happen to disappear as a company. And basically, our entity is split into two, between the operational company and the holding company. And so all the funds of the SPVs is being held separately to what we do as a company. And the angel lead is kind of registered as the main manager of that SPV. or owner of the SPV, we are acting as the asset manager, which means that while the SPV and the investors are happy with the service that we're providing and sort of managing that through the lifespan of the SPV, there's no problem at all. And we just, operate once a year on kind of filing the relevant documentation. And if they wanted to swap us at some point, they can decide to swap us as asset manager of that SPV, which is also what would happen in the cases, for example, we disappear or go bankrupt. It's not going to affect, let's say, the SPV in itself. It will mean that the SPV will need to find a new asset manager. And that's the case for most platforms similar to ours in the market.
Thank you. So basically, the process of managing it is mostly on the investor. And okay, that's good. So basically, first to set it up, why someone can consider using Uniborn or such similar platforms is basically just to give all the admin work to the people who know how to do it, instead of jumping through hoops of creating the company, then setting up the bank account and onboarding and doing KYC for all of the investors and onboarding them into that. So they can pay you a little bit, and then you can manage all the complicated stuff. Yes, Aleksander? I think he wants to contradict me.
No. I just wanted to say that. So I've set up quite a few SPVs on my own, and I just recently got fined by Estonian tax authority for the reason that I forgot to submit annual tax reports. So having somebody actually taking care of it is super convenient, because typically an SPV is something which you need to put a lot of effort into when creating it, but then you forget about it until there's an exit, right? And I literally forgot about it, so we had to pay some like 500 euros for not doing it on the right time. So just wanted to point it out, but it's pretty good if you actually have it covered.
Yes, definitely. And you don't want to be on the outs with the tax authorities. I think 500 is still a good fine, not too much. So that is the setting up and the managing process. Now we also know that there was a little bit of addition to pros and cons that we're keeping score of. Now that we know how to set it up and what is an SPV, maybe we can talk a little bit more. As we've touched upon, it is needed, but it's not always needed. So if you have only one angel investor who can afford to invest, I don't know, 500K, you technically don't need SPV. You just put that particular person on the cap table, and you're happy to spend your investor money. But in which case, founders might want to consider pulling their investment into an SPV, and what they should keep in mind when evaluating if it's for them or not. Maybe Sebastien, as you have such knowledge on that topic and also have some data points, maybe you can tell us a little bit more about it.
Yeah, happy to take this one as well. So as you mentioned, there's a number of things to consider. Like I'm a big advocate for them. I think we've discussed that there's a number of advantages that you want to look at, but I think they're not always, let's say, the best solution depending on how much you want to raise. So I would say how much funding is required for the round that you're looking to raise at the moment, and by how many people you're going to be collecting that money is very important. As you mentioned, SPVs are most useful when you have a number of investors that want to put money into your own company. If it's a single investor or a large ticket investor, it might not be the best idea. I've actually been talking to quite a few angel leads in the last year about how they invest, what type of companies they invest in, whether they like SPVs or not, and sort of what are the reasons why you would decide to engage or not. Some of those investors that say that they're signing 100K tickets on their own want to do their own due diligence and sign all the contracting, which they already have templates of themselves, and it's not that useful. Even sometimes a small group of angels that is all based in the same country and has done angel investing before, so they know the documentation and the legislation at home, it's not really a problem. The second that you want to start pulling in angels from different countries, it starts to be quite useful to consider doing it via an SPV, because then you avoid a lot of issues in terms of doing the documentation in several countries and potentially several languages as well. So that's something to consider. Well, the valuation also is interesting. I think some of the VCs might want to be involved, in a larger SPVs at like a later stage. They don't want to do that like early on. I think most VCs that we spoke to said that it's not something that they want to do, that they're happy for an SPV to happen on the side, but that they want to invest directly and be on the cap table directly. But then the speed of execution is also something important to keep in mind, right? So sometimes you want the money to happen, to be wired very fast, and from investors to invest really quickly. VCs typically take a long time to do due diligence and to decide on how they want to do things. So depending on those different factors, as a founder, you'll decide whether doing an SPV and getting several people to pull in their money together to close the round quickly is something that you want to do, or whether you would rather wait, involved VCs, later on down the line, or just take in individual investment from several angels if we're only talking about a handful, independently, rather than pulling them as under an SPV. So I think those are the various factors that we mostly hear about or keep in mind from the angel investors and founders that we speak to.
Thank you. So basically, to reiterate, one, if you have a lot of investors wanting to invest small tickets, then it's good just to keep your cap table clean and to manage this process in a more manageable way. And then also, if you have angels coming from different regions and countries, just to manage this process and legislations and whatnot. So all of the legal process. Also, it's good to have a specific SPV set it up for that and manage the process for it. That's good to know. Okay.
I would maybe add one little thing as well, if I may. So I would say that depending on where you decide to register the SPV, that has implications too. We're quite lucky in the Baltics, or specifically in Estonia, that is a pretty simple and straightforward process to set up, even if you're not doing it with a platform like ours as an independent angel. It can be easy. In some other European jurisdiction, it's a lot more complicated, and it can be a lot more costly and time consuming. So that's something to keep in mind too. I think that the SPV as an instrument is very good for a number of reasons that we've discussed, as long as you understand where the challenges lie and whether they apply to you or not at the different stages of the development of your company, or for the angel investors involved. But where you actually register it is very important too. Not every European legislation or jurisdiction is easy or is cheap. So I would definitely keep that in mind. And there's a reason why we're operating out of Estonia currently, is because luckily it is quite straightforward to do here and to keep tab on these things. I know that I've talked to investors, for example, in Poland, to name one country that I know where it's been a lot more complicated, not so easy. Or Hungary as well, I know it is a lot more complicated.
How does it differ from a more welcoming countries? So what are the main differences between let's say Estonia, where it's obviously all digitized and everything is easy, in comparison to Hungary or Poland?
Yeah, so as far as I understood from those angels, it's like the time to set up everything, the documentation's required to be, sent back and forth to the authorities to have the deal approved. And then the cost in general of the basic registration, which in Estonia is very, very cheap, because it's been streamlined and digitized. So all those three things are the biggest issue. And I think speed is of the essence when it comes to early stage investment. Us being able to proceed with everything within a week rather than have to wait 6 weeks makes a big difference.
Are there any other I'm curveballing here to you. Are there any other very nice locations, easier countries to set up SPVs from the top of your mind, more hospitable to creating such things? Or
yeah, it's a great question. I don't want to get in over my head. I don't know all of the other regions where that can be easy. I think the Netherlands is not too complicated. Some of the other platforms are set up over there. I think in the UK, it's actually quite easy to do it as well, as long as that's a market that you're operating in, or where it's easy for founders to do that in the UK. In Europe, there's not many others. The rest can be actually quite challenging. I would say the Baltics, right? So it's not per se much more complicated to do that in Lithuania or in Latvia. Though still, I think there's still some advantages in Estonia.
Estonia is the best, saying Estonian person. That is true, unfortunately. I realized it when I started working with international founders. I realized how much easier Estonia has set it up the processes here and to make it more business environment friendly. But also during that particular question, you have shared a little bit that you said that VCs are not as keen to use the SPV processes for themselves. And also when we were talking a little bit more about having a lot of different investors on your cap table, it triggered my mind to think also about crowdfunding. So are there any ways to use SPVs in the VC VC environment? And also can in any way SPVs be utilized when fundraising through the crowdfunding platforms, for instance? I'm happy to give this answer to any one of you, or actually would be great to hear the perspective of both of you on that particular topic. I will start with Sebastien, as you have unmuted yourself already, and then I will give the word to Aleksander if he has anything to add to what you're going to say.
Sure. So, I mean, on the crowdfunding side, right? I've personally angel invested through a number of crowdfunding platforms, whether it's Seedrs, Crowdcube, Republic. There's quite a few others out there. I've kind of tried all of them to some extent because they were deals that I really enjoyed. I think they do have a number of challenges with regards to how the knowledge of the investors investing through crowdfunding platform is, and then the documentation and the clauses that you sign. I think Alexander's mentioned earlier that sort of the how do you say, feeling of the investors with regards to how the company is performing and what they're sort of entitled to do or to suggest in terms of how the founders need to run their company is kind of inversely proportional to how much they're investing. I think there's a lot of that when you look at common sections within deals on crowdfunding platforms, which can be quite interesting. Having been part of a few myself, I can see it and sometimes wonder what is happening, but that's not really the biggest problem. I think the biggest problem lies in some of the valuations of those deals that don't make sense at all. I think if you look at some of the most successful deals on crowdfunding platform, the valuations at which those deals were invested in for people that come in with very small checks doesn't really add up. And more specifically, what happens once the deal has been signed in the years that follow, there's a number of issues that come from there as well. And I think this is why platforms such as Uniborn differ a little bit from crowdfunding platform, with having more than 2 or 3 investors, but a lot less than several hundreds or sometimes thousands of investors, because how the, let's say, dilution clauses have been discussed, or sort of what happens in case of liquidity events, and how much the platforms actually hold the investors to that, or the lead investor to that, is, I think, a lot more gray area, or definitely not disclosed in the way that it should, which is something that we're very much sort of staying away from. So I'm not completely answering your question. Maybe I'll let Aleksander be a bit more specific there. But I think while crowdfunding platforms are great in practice, or sorry, on paper, or at least from a marketing perspective for some companies to get the word out and bringing some of their clients as investors is great. But in terms of like the way that it is sort of upholding some of the clauses that you would expect within shareholders agreement, it might be a little bit more difficult. So that's what I would say from my side.
And also, I think also I've seen a couple of cap tables that have been invested through crowdfunding, and then it's just, we used to call it a party guest list. And I think utilizing SPV for this particular way, it's also easier, because then you again have just one line and nobody needs to know what has happened there and how many actual investors you have received who have invested, I don't know, $100 into your company. But also, as Aleksander has a little bit more experience with accelerators, which is, in my experience, usually more of a VC type of investments, have you ever had to utilize SPVs in that process, or do you know how VCs can utilize SPVs? Just for the founders to know, and do they actually utilize SPVs in their fund management and investing practices?
Mm-hmm. So VCs usually don't. So I'm looking at it. It's, you know, SPVs is just a tool, right? So and I'm going to use the tool which gets the job done in the most effective and the way I want it way, right? So it's not SPV's fault that VCs don't use it, right? So it's just usually not the right tool for what they want to achieve. And maybe something to point it out here, again, speaking very bluntly and directly, is that VCs are going to want a lot of control over your company. And typically SPV structure doesn't have it, right? So there's like no, it's not a good tool just to achieve that, right? So it's a very good tool to pool hundreds of investors together so that you would only have to deal with one. So the investors have actually also one thing which we didn't really touch upon is the liability. So the liability which I will have being a part of an SPV compared to a direct shareholder in the company is different, right? So I have less liability being in SPV, and actually it matters, right? So if I'm doing a lot of investment, the liability, even though it's not a lot, but it adds up, right, over the investment. So bringing liability down is a huge benefit for investors. But VCs, and that's why I would always, for startups, recommend to really read the contracts. And I mean, very carefully read the contracts. The VCs will going to have a lot of control, and that's part of the game. I mean, this is okay, but you need to understand what you're signing. So, and that's why as an VC, I would not like, I don't even know any of examples where they would have used an SPV. It's always directly into the company, mostly straight into the equity, again, because this gives you more control. Sometimes also as a convertible loan. I mean, as an accelerator, we usually invested as a convertible loan, but I don't consider us a venture capital due to the, let's say, we're very startup friendly. Typically in the very early stages, typically VCs are later stages and not startup friendly really, right? But otherwise it is structured similarly. But again, earlier stages, typically convertible loan is a better tool than straight into the equity, because that gives, let's say, founders more motivation to build their company. So, but that's kind of, so VCs and SPVs usually they don't go well together. But the question also was, why would I as an angel prefer, right? So if you're a founder, you still need to fundraise, even if we talk about the SPVs, right? You're still fundraising. Sometimes the lead investor will help you, and lead investor will bring in other investors, and they sometimes want to meet you and sometimes not, but it's still mostly you fundraising. But then the question is that, so if you have decided that you would want to use an SPV, you need to also sell this idea to the investor, right? And one way of selling it, and that's one of the reasons why SPVs are used a lot, is that typically you have minimum ticket size in founding rounds, right? So let's say if you're raising $500,000, my suggestion would be to put a minimum ticket size of 50K or more, right? So, and many angel investors, if you look at the statistics in Estonia, and if you average them out in terms of a number of angels in Estonia, the average ticket size per angel is around 5K. So it's a very small ticket. Because angels are investing their own hard-earned cash, right? So that's what you need to understand. This is their money. It's not that they're investing somebody else's money. And in order for your angel portfolio to work, you need at least like 20 investments to be diversified. And then if you then add 20 together, each of them 5K, all of a sudden it's like 100K investment. And that's actually, even for an angel, a lot of money. So with 5K tickets, however, I'm not getting in the deals which I want. So even as a Contriber Ventures So Dealum also, we have a investment fund which is created with the founders of Dealum, which I'm a leading partner in, right? And we have invested as an SPV or being a part of SPV because the ticket sizes were getting so high that that was our only way to get in, was to pool in money with other investors. So for angel, this is one way, right? So to bring the ticket size down for yourself. Less bureaucracy for me as an angel. Typically, if I'm in an SPV angel, I'm not doing due diligence. I'm not signing investment agreements. I'm not typically signing shareholders agreements. I'm only signing a loan agreement with an SPV, which is much, much less bureaucracy. It's much easier for me to go through and understand when all the investment, shareholders agreement and whatnot, and NDAs and everything which comes with an investment, right? So for me as an investor, there's a lot of benefit being on an SPV, Robert. But again, like I said, for VCs, not really benefit because they have the people to do the due diligence, they have the money to do it also, and they want control.
Thank you. That's actually a good point that in my perspective, it always was the beneficial for the founder to manage the cap table and to have a less juggling of investors, but also it's nice to see the perspective of angels and not only through the legal side of managing the whole legal setup process, but also understanding that if you're working with angel investors, you have people investing their own hard-earned money and sometimes not having a possibility to invest 100K. So it's a nice way to get a bunch of buddies together, invest 5K into the SPV, and then invest, I don't know how much money you can collect, and then play ball with bigger boys. So when you want to stay either in the cap table or just get into an interesting deal, as it sometimes happens when you have a very attractive startup, everyone suddenly wants to invest and it's just shut up and take my money. So you can also get a little bit of that into your portfolio, which is good. But talking about the investing and then also how this whole process works, probably we touched a little bit upon that, but also I think for founders, it's always something they underestimate, but something they also want to speed up. Basically, how long does it take to go for the deal to go through when using SPV? Because you mentioned that you have to set it all up. You need to get on board a bunch of investors. You need to create a company. You need to collect all of the interests. How long does it take, let's say, from the idea of having SPV all the way to having money in the bank account? And maybe you can compare it to the usual deal if it differs in any way. Sebastien, can you answer this, please, to us?
Yeah, happy to. I mean, ultimately, it's really difficult for me to give a time frame. I don't want the listeners to think, oh yeah, there's an exact amount of hours or days that it takes for that to be done, right? I think what I can say is that with platform like ours, with Uniborn specifically, we've understood that in order to stand out, we needed to make that really fast. That, like, we know these days, especially in competitive markets, like, you know, end of 2021, when like deals get like signed within like a few hours, you need to be able to execute quickly if you want people to move forward with you. So as a platform, we can operate within, I would say, a matter of days to have like a deal completely closed and things wired. I think we proved that we could raise our own deal for our own angel investment for Uniborn on the platform in 10 hours. What takes the longest is the commitment from the investors. Once they basically decide that they want to invest, to know how much and to close the commitment from all of them. And then from that point on, how long it would take them to actually wire the money. But if the investors are on the ball and they're ready to sign for us to process, you know, the 6 steps that I've mentioned earlier, it can be done within a matter of hours. It's pretty quick these days. Even the bank account registration, when it's not been blocked, is actually very, very speedy as well. And I would say that as long as the investors are willing to move fast, we can operate as a platform and facilitate this very, very quickly, much quicker than most people think, which is great because the bureaucracy then doesn't take weeks, but it can be done within a matter of days. I think it's just that as a lead, you want to run a tight ship and know that your investors, once you send them the information via email, will open it, send their allocation relatively quickly, and when all the allocations are done, we'll actually be able to sign the documents, send the documents, sent back, and then move forward with actually wiring the money. But as a platform, we've made sure that this is something that can happen these days incredibly quickly, which I'm really happy about.
So basically what you're saying, it's usually the human factor of committing and wiring the money takes the longest, but if you're using some specific platforms, for instance, Uniborn, the whole legal aspect works quite well and quite fast, especially if you're doing it in Estonia. I should work for Estonian PR agency. So, okay, as per usual, there is no certain time limit in or time frame when you get an investment. So dear founders, be patient, find your preferred investors, and then Uniborn can take care of the complicated but apparently very fast process that they have set up.
Yeah, I mean, I guess I can maybe just to give a bit of an idea, right? So the general onboarding for the lead investor at first, right, is done in a few minutes, less than 10 minutes, depends a bit on the investors and sort of like the background, but that onboarding gets done very quickly. One part that takes a little bit longer for some of the investors is to actually go through KYC through the partner that we're outsourcing that from. But again, for most people, it will happen within less than 10 minutes. So those are things that don't actually take a lot of time, as long as they're sort of structured and done one after the other in sort of a nice series of events, right? I think, and that's kind of why having a clear communication channel helps the investors, and then in this case, the founders, to get the money much quicker. So you kind of just want to be sure that you're communicating that efficiently and doing everything in platform where those notifications can be sent out simultaneously to all the investors kind of helps to speed that up. So just to kind of get an idea of time frame, and then the rest is the investors moving relatively quickly.
As you actually have access to all of the process, I would love in some years to see the analytics on how much time it actually takes and which process takes the longest. That would be something I would love to see, but I like numbers. And but thank you so much for the answer. I would, as a person who likes numbers, and I have seen a bunch of cap tables in my life, as I have been working for many years for Accelerator, and we've been investing, and I have been evaluating all of the startups coming in. I was always curious, and probably Aleksander has the best perspective on that, as he has been investing into over 100 different startups. If you see an SPV on the cap table of the founder or the startup that you're planning to invest into, does it in any way changes or raises any eyebrows on your side, or are there any specific questions you would be asking? So should founders be aware of anything that can in the future affect their future fundraising if they have SPV on their cap table?
So yeah, thanks. So maybe first, like a general answer. Again, quite blunt is that if, let's say, if investor really wants to invest in your startup, cap table will never be an issue, right? So if they really want, we're going to find a way, right? So typically it's a sign of, that maybe they don't want it that much. So we're going to, let's say, start digging in details. So I've been on so we have invested in one company which is currently performing extremely well in our portfolio in Contriber Ventures, and on their cap table there's 95 shareholders, and never been an issue, like really never. And I've seen issues where you have 5 members on the cap table. So just to kind of say it out loud, right? So in itself, the instrument itself or the number of people on the cap table is not the problem. It becomes problem if there's something else wrong, right? That said, however, if I see, if I would have two choices: either a cap table where I have 20 very small shareholders, maybe holding 0.5% only, or one SPV holding 20%. I would choose one SPV holding 20%, because I know that I as a, let's say, next round investor would have to deal only with one person instead of having to deal with 20. So this is definitely something what I would, let's say, prefer in that sense. It makes it easier. But again, there's a balance in life, as always. For example, the fund which Build It seed fund, which I'm a founding partner, where we invest and we are registered as a licensed fund in Latvia, we also have to follow KYC and AML rules, which means that if we would now invest in the later stages to your company and you have an SPV on a cap table, we still need to know who are the final beneficiaries. And that becomes more difficult if there's an SPV. So that means that I'm not only now looking through one cap table, but I need to also see what's behind an SPV. Typically, behind every investor there's a holding company. So I need to go on that level. Typically, sometimes behind a holding company, there's more than one owner or another holding company, right? So this will add an extra layer which I would have to take care of, and AML is a pain in the ass, right? So this is something I wouldn't even wish on my enemy, but they would have to deal with it. Unfortunately, we're in an environment where it's part of the business. So in that case, I would actually rather prefer to see everybody and final beneficiary straight on the cap table. But like I said, it's a game of balance in the end. So some, what's the saying? Always win, sometimes lose.
Good saying. That's something thinking out loud, considering that when you're creating an SPV, you usually have to perform KYC. Can't this data be transferred automatically in some way? Or you, as the next investor, you actually have to do another round of KYC and AML for the people on the cap table?
So how AML is currently, similar to KYC, how AML currently is let's say, the law is currently is that in every organization there needs to be at least one person who is responsible for the AML. It goes under a criminal and not civil law, which also actually indicates that you cannot actually trust somebody who says, hey, I've done all the job for you, just take it. So you don't have the luxury. Maybe de jure, de facto not, right? De facto, you actually need to check every single source on your own. And that is actually quite a lot of hustle, which is, again, something nice. If I'm a part of SPV, then I don't need to deal with it, and a lead investor is taking care of it, or Uniborn, for example, right? As a service provider. But as a VC, for example, in later stages, at least we haven't found a way how to just, transfer it from one entity to another, because you take the responsibility. It doesn't matter where you get the data, but you still take the responsibility, right? So it's kind of,
It makes sense. Yes. Zero trust. As anything online nowadays, and in investment, zero trust. Okay, that does make sense. Thank you so much for the answer. And we have one last question that we can take from the audience. And basically, the person is asking, what would be your recommendation for the pre-seed investment? Would SPVs be beneficial, or they should focus on one main investor for the easier growth? Aleksander, what would be your perspective on this?
Again, there's no right or wrong answer here, right? So it depends on the circumstances, right? So, however, I can tell you how what the reality looks like. So that I can tell you, right? So the reality looks like, typically you would have several investors because you're not able to get the money from one investor, right? So if let's say your life is so much easier if the fundraising would look like you would go and talk to one investor, he gives you money, done, back to building business. Almost never happens, and I mean like almost never happens. Most rounds are more than one investor involved. The reason is from the investor side, first of all, investors also are what you call herd animals, right? So that the fact that some other investor is also willing to put in their money makes it less risky for me. I know factually it doesn't make less risky, right? But it feels like, right? Because there's another idiot who's willing, risk with everything hard-earned cash. So I'm not the only idiot. So if we end up losing money, it feels much better to lose it together with somebody rather than being alone. So the reality is that it's very difficult to put rounds together where you only have one investor, right? So you typically are pooling money together from several people. So SPV is definitely then an option. So then I would just decide on the ticket size, right? So it depends a little bit on the round. If we talk about pre-seed, then like let's say anything below 500K. Like I said earlier, I would never pick a ticket size which is less than 10 to 20% of the round size. So if you're putting together a 500K round, then your ticket size could be anywhere between 50 to 100K. I think that's like a good ratio. But again, there's no rule, right? So it's your game. You make the rules, but it's just kind of like how the game is usually played. And then if you cannot find those individuals who are willing to put in 100K each, then you have actually no other option than to pool it together into an SPV. So that would be my answer. So maybe a bit wobbly, but that's how it is in real life as well.
It's never a straightforward answer. It always depends on the case-by-case situation. But as we discussed, I think it's a good rule of thumb that if you have more than X number of investors who are willing to invest, it's good to pool into the cap table if they're investing smaller tickets. That can be a good option. But if you have one individual who is willing to cover the whole round, maybe it's easier to just deal with that. Have one individual on the cap table, but as Aleksander has shared with us, it's almost never happens, unfortunately. This is it for today. We are also running out of time, so thank you so much for your time, Sebastien and Aleksander. So if you guys are considering to pool your investment into SPV, consider Uniborn, who can automate the whole process and make it as easy as it can be. Or if you are an investor or a startup looking for funding, then consider joining Dealum platform. We have over 200 different investor groups who can share their knowledge and their hard-earned cash with you. This is it from us for today. Thank you and have a good day. Bye.
Thanks for having us.